Good evening, everybody. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I am back to talk about the stock market, our specific stock market investment strategy using closed-end funds, and really just talk about some life as a whole. So, uh, to get the normal disclaimers out of the way, this is an unedited video. No what you'll hear in the background as I film these in my house. I'm not a financial advisor. I am a strategist, and I'm a financial strategist. And I don't speak like the herd. I walk in very limited company, and sometimes I walk alone. So, as I've been saying, uh, as I've been asking, help me get the message out because there really is just a better way to invest than the traditional stock market advice, the traditional 4% million plus in retirement, 60/40 stocks and bonds portfolio, heavy investments into the S&P and index funds and mutual funds and single stock funds. There's just a better way. So help me help more people and get them information that they maybe haven't seen yet. That closed-end funds are an awesome way to either build your portfolio solely around or to add to their portfolios to really supplement their retirement. Because with closed-end funds and with our strategy is not to sell our principal. Our strategy is to increase. I mean, everybody wants increase, right? But our strategy is to grow the principal investment and live off the dividends because we know that as the market goes up, and yes, historically, traditionally, et cetera, the market goes up. But as it goes up, it's going to rise and fall. And our principal investment is going to rise and fall. Therefore, we want consistent dividend payers. We want growing dividend payers that will reward us for owning funds so that as our price, as our growth, as our overall portfolio worth rises and falls, that we still get paid in dividends. We still get paid amazing dividends. So whether your strategy is to buy and hold, that set it and forget it kind of methodology, if it's swing trading, like if you grow at 20%, sell it and you swing the money forward, or something else that's just kind of foreign to me, or maybe different for me. Um, Heck, maybe you even do the dividend reinvestment program where you set it up that every dividend you get paid from a certain company, your uh, brokerage is automatically reinvesting that money back into the same fund and buying you half shares or partial shares. Uh, Eventually, essentially buying down your initial overall average investment into the company and pushing those dividends forward. Or maybe you're like me, where you much rather collect the cash and invest it where you want to invest, because not every company is always as good as every other company. So, regardless of your methodology, regardless of your strategy, there is a better way to invest, and most people just don't know that. So, help me get the message out. Share the videos, like the videos, subscribe to my channel, comment on videos. I'm very active in sifting through comments and responding to comments. If you've got questions or you want feedback or you want to give me your feedback, by all means, drop me a comment. But all of those things help push the message out to get more people involved and to help more people. So this week, I hope it's a much shorter video. I know, and I'm I'm long-winded and I like to talk facts. I'm long-winded and I like to talk through my rationalizations of things. I like to share data and information, but this week I've tried to keep it shorter in that mode, or try to keep it more brief. So instead of the long market updates, here are some quick market updates. The One Beautiful Bill passed both chambers, and President Trump signed that into law on July 4th. Uh, I don't know where they got it from, but they pulled out this cute little school desk and stuck the President of the United States emblem on top of it. He signed it on the White House lawns. But uh, that's important because the market is already in extreme greed mode. So you can expect that ticker, that pendulum swing to push further into extreme greed mode. At the end of last week, President Trump also announced a new trade deal with the Socialist Republic of Vietnam, which sounds a little oxymoronic to me. Socialist and Republic in the same title. But at the same time, the trade negotiation, the trade deal they announced seems and sounds like a slam dunk for the United States. And in no surprise, the Federal Reserve still hasn't lowered rates. And President Trump and Secretary Bessent are now publicly looking for a replacement, which we've talked about at length. And it's really the one thing we're all waiting for because tech is booming. I mean, last week, I think Microsoft was the biggest company. This week, it's NVIDIA. But we should expect a weekly jockeying for position between NVIDIA, Microsoft, Apple, really anybody else. I mean, Meta is going all in on tech. They've essentially stopped hiring humanity and are pushing everything into AI. So, I mean, you can argue on jobs and all that. That's probably a conversation for later. Uh, but if they're doing it, you can bet others are as well. So we should see record growth in tech companies, and we should see more jockeying at that top spot. And in that, it's kind of odd. I don't watch the media, so I get my media information from other sources. But it still seems like the mainstream media is pushing this narrative that people are selling the U.S. or like they're selling their U.S. U.S. applications, investments, um, and that couldn't be further from the truth. I mean, the reality is that there is record number invest or there's record there are there is a record level of investment into the United States right now. Overall, doesn't sound like it, but overall, the U.S. household debt is down, which we all hear about how high credit card bills are right now, and we do ad nauseum, and it's true. But at the same time, if you look at the data overall, the U.S. household debt is down, and take-home pay is on the rise, and business development growth is on the rise, and the onboarding of American manufacturing and American wealth is just taking off, right? And that doesn't sound like a sandbag population. We've all got debt. I mean, I'll be honest that I've got debt that I've got to pay off. But and it's weighing on our budget, but at the same time, it's not crushing our budget like it has been. Or I get, well, that's not a fair. The grocery store for the first time in years is noticeably cheaper. And week to week, that adds up. Like our grocery bill is maybe $40 less this week for the first time in probably 4 years, 5 years. So that's pretty incredible. Uh, $40 over 4 weeks, $160. But that money comes back and 150, $160 might seem like chump change compared to whatever you're managing in your budget. But that's more money in our overall accounts that we can do something with. It's not like we're having to sift through everything and scrounge for the corners to make our ends meet. And and I get the data and I know my data because I crunch my budget, even though it's a pain in the ass sometimes, but I crunch I crunch our budget and keep up with that stuff. So that doesn't sound like a sandbag population or a sandbag populace. With decreasing inflammation, with decreasing inflation and decreasing taxes, you can expect the markets to take off. Honestly, they already have. Like we're already in extreme greed. You can expect that to continue. And if we can find anyone to lower short-term interest rates, that CNN market sentiment tracker, the fear and greed index, might actually hit full throttle on extreme greed. Think about it, is in all the positive motions inside the US economy, inflation, stock market, the US dollar still acting as a reserve currency, And all of those things moving in the right direction. If the Fed actually cut rates, man, it might be like putting jet fuel in a race car, like pedal to the metal, just floor it and go. It'd be crazy. And as amazing as that is for everybody, it makes investing a bit challenging. I mean, last week I argued for pretty much everything. Like you could invest anywhere. And we did. We bought across the market. This week's a little bit different because everything is shifting into extreme greed. And I think it's going to continue shifting into extreme greed. So so last week we were extremely choosy in greed territory. And we bought Monday. By the end of the week, the market was in extreme greed, right? And the herd was piling in, and the herd's always late to pile in because it's like they can sniff out the greed and they can sniff out fear. They can't sniff the middle. First sign of fear, the herd pulls back, right? It's like blood in the water for sharks, but it's the wrong sharks. So with the herd piling in, it comes down to your specific strategy. You can buy in times of extreme greed. You've just got to you have to demand a discount. You have to scoop a deal with a long-term strategy in mind. And it's getting harder to find. Well, no, I won't say it's getting harder, but we'll say the list of opportunity is getting smaller. Last week, my initial uh, copy and paste from the CF Master to the individual weeks tab, there were more stocks. Like if you looked at the screen, the number of lines uh, went beyond the parameters of the screen. This week, everything fits into the same screen. So our available choices is narrowing because of rising prices. Now you can say it costs more or it's worth more, regardless, as cost or as worth goes up and as dividends remain the same. And then, if costs are going up and net asset values are not climbing as fast, we're going to see the we're going to see both a shrinking dividend because the dividend's the same and the cost is going up and it hasn't caught up to the new cost. We're also going to see the discount window close, which is what we want to happen. Honestly, we want the net asset value to go up. We want the discount to shrink so that there's a if you think of closing a window, there's a smaller gap between what you're paying and what it's worth. We want that to happen. But as that happens, it actually culls out or really shortens out our possibilities list in picking funds. So first and foremost, we're not, we just bought last Monday. We're not going to buy this week. When the market is in extreme greed, it's time to remind yourself, it's really time to remind everybody, me included, that the extreme greed season is a lesson in caution. It's very much a fear of missing out, right? Like you want to get involved so you don't miss it. And you would buy something that you wouldn't normally buy simply for the sake of catching it before it takes off. And you can argue for that. Like if your goal is to sell it when it takes off, I get that. So maybe you're like, I'll get to this in a little bit. FCO's discount has closed below 1%. So there's still a discount. It's just not as great as it was 6 months ago or even a month ago. So you would buy it now, hoping, knowing, expecting it to continue going into premium territory. And your goal would be to buy it while you can, knowing that it's going to hit premium and then be worth more than what it's actually worth, which is great. But maybe instead of catching that one, maybe there's a better investment overall. And that's kind of where you have to weigh your strategy. FCO is a great investment. It kind of depends on your long-term strategy. Are you going to buy and then hold it regardless? Or are you going to buy it, wait for it to climb, sell it and reinvest your funds? It really just kind of depends on what you want to do. So you can invest right now but it's getting harder. It's getting harder to target long-term strategy in the midst of rising prices and decreasing discounts. It's a great opportunity, but you've got to be really cautious. On our end of things, we will sit and watch. I mean, we just bought on Monday. We have probably one last lump sum amount that we would buy into. And I mean, honestly, I want the herd to push the cost of things higher. I want them to close our discount windows. There's funds that I would like to sell at that 20% mark. I have several funds earmarked, uh, ZTR being one. I want that fund to increase in value. So when it hits a specific price point, I can sell it and push the money somewhere else. Um, right. But we want to use the herd for what they're best at. They're best at arriving late and investing heavily into this greed mode. So we want that stuff to take off. And with the push into extreme greed, there's going to be a pullback at some point because that's how the market goes. We have the dip a couple months ago, several announcements. The economy takes off. The jobs reports are great. The manufacturing onboarding, the trade deals. Um, Whether you like or dislike the stuff coming out of Congress, you have the stuff coming out of Congress. The only holdup is the Fed. So we have all of this momentum inspiring news coming out, and we're pushing headstrong into extreme greed. And I don't know what it'll be, but something will happen. We'll have some little blip that'll strafe across the market for a day or two, maybe three or four or five. Maybe it impacts for the whole week. Maybe it's that big of a deal. But we'll have a dip of some type, and that'll be the best time to buy. So we can find pockets of dog corners of the market and extreme greed. It's possible. But at the same time, I would much rather buy a dip. But that's just me. So I would buy if I felt I needed to. But at this point, this week, tomorrow, one, we're not buying because it's not our time. It's not our schedule. But two, as things increase in overall worth and cost, as things increase, I'd much rather pay a discounted, dipped price as opposed to that increase. So if we're not buying right now, which we're not, I can't speak for you, but if if we're buying right now, is there anywhere we can invest with as great as the market is doing with as much as it's really taken off in the last week? Is there anywhere that's still great? Well, yeah, I mean, we're on the forefront of America's golden age and this technological revolution. Discounted tech is still an option. Now you're going to pay more for it now than you were a month ago, but it's still a great option overall because if we look at just right now, yes, it costs more to buy in, but if we look at the big picture, the tech boom is nowhere near over. So who knows what the price will go to? Real estate is a great option, mostly because short-term what the lack of change of short-term rates is weighing on the real estate market. A lot of people are getting into the market now at higher rates. Just read a report that said there's more individual investors buying right now than corporations, which is crazy. But there are a lot of corporations that are dealing with bigger issues than single family home purchases or single dwelling, whether it's apartment, studio, house. I mean, pick your door option. Uh, Bigger landlords, bigger real estate investment trusts are invested into more than just a single door. And they're dealing with all of that stuff, which is allowing single investors to come in and start buying stuff. So that's an interesting opportunity. But real estate as a whole, because these bigger groups are weighed down by uh, commercial real estate, the ongoing like office retail, uh, really what Doe's was pushing for. Like it's great that you want to work from home, but we really want you in an office working. as companies come back to that, we should find more office retail space coming back online, but it hasn't been that way. Uh, so if you can find it cheap, real estate's a great option. And then it's still very much a bond and bond proxies environment. It's tech because we're at the forefront of things. It's real estate based on short-term interest rates. If you can make a profit with high rates, you can rake at a low rate. But bonds as a whole, right? So it bonds and the short-term interest rate market work inversely. So with high rates, we have lower bond prices. With lower rates, we should increase those bond prices should increase. The question will be at the end of the year with the dividends, but I think we'll see more special dividends at the end of the year if the rates get cut. So knowing where the herd is and the herd is surging back into the market and bond prices are still meh. I mean, they're a little bit higher, but they're not crazy. If interest rates get cut, bond prices should go up and municipal bonds should look extremely well to the herd because the herd isn't just investing into the market at large. The herd's also sitting on cash. And with about 7 trillion invested in money market funds, if short-term interest rates drop, money market fund rates are projected to drop as well. And I don't know about you, but so my rate at Fidelity is about 4% on a money market fund. And it works great as a savings account because it pays better than the partnership Fidelity has with banks. I think that's like at 1.9. The best credit union rate I found is 0.5%. Most pay it 0.25% or even 0.1, a tenth of a percent. And those still pay better than your common bank or even your big name bank. So at 4%, that sounds amazing. And if short-term interest rates drop, which we all hope they do, and that weighs on the money market accounts and those drop, I mean, I like the 4% rate, but 3% is still better than I can find anywhere else. Just presents a different kind of problem, right? But a 10% municipal bond rate sounds a lot better than a 4% rate, right? And I don't know what everybody else is paying. I mean, if you're at 2%, I mean, gosh, if you've got 2 trillion and it's 7 trillion for America at large. It did not represent single owner status. I mean, gosh, if you're a billionaire and you're sitting on a 4% rate, 10%, it sounds like a godsend. So, and it's a consistent 10%. That sounds freaking amazing. So, yeah, I mean, it's still very much a bonds and bond proxy market, and I think it's going to continue that way till we really see short-term interest rates shift. We're going to see pockets of opportunity here and there, right? And it's tempting to buy everywhere because we had the dip, and then like for about the next year, anywhere you invest is going to be better off than what is it? Recoveries following a dip. You can pretty much buy anything and see a gain, right? So almost you can make a profit almost anywhere. But if we're looking for real long-term growth and things that are data-driven and herd-driven, we want to use the current market in the best way possible for the long term. So that still presents us like the best thing is still a bond and bond proxy market. And then we use the other stuff as it happens. So enough of that. Let's get into the list and we'll go from there. Let me share my screen. All right, so here is the sorted list for the week. All right. And it's not that much of a shorter list this week, but I want to say last week when I started sifting through the list, it was like at 32, and you just don't see that from where we are. So, first things first, everything makes the list for a reason, even these three that for us are still dollar cost average buys. So we want to weed out everything that's not a monthly category. And then we want to sort by yield. And we want to sort based on the 9% mark, unless there's a really good reason for not, unless there's a really good reason for a company who doesn't have 9% yield. So we can eliminate the bottom two. We currently own these. Yeah, and they're labeled as safe because the default rate on municipal bonds is super low. They are, I mean, it's like a boring investment. I mean, you buy it and they pay you and that's it. Um, I went through Calamos and Eaton Vance last week, and my thoughts haven't changed. Um, you can make an argument on the Eaton Vance side because they sell covered calls, which really just, I mean, it helps to juice their dividend. But unless you're already invested in them, you're paying a higher price than normal. Calamos has been on my radar, but it's not enough for me to act on it. I'm not an Allspring fan. Eaton Vance, I think we, as in me and my family, I think we have better options than Eaton Vance. They're both tempting, but they're also like everything else. I mean, the cost is up, but I think we have better options based on what we already own. CIF is great in our Roth. I've talked about it before, but it's not going to stick around and be an ad for our individual account. Meggie, we own. It's great when the discount is close to or exceeds the 1 year average, but outside of that, um, yeah, it's just not going to make the list this week. FCO will stay simply because it's still on discount. I still see FCO going at a premium. The US right now is prime BDC development territory. And with them being a completely all American company doing both bonds and private lending, I think they're set up great for it. EIC, I've talked CLOs at length, and we already own a company that does CLOs. Plus, this one is, I mean, it's double more than it's three times what we're already paying for, or what the current price is for OXLC. So we'll stick with OXLC, which means we can get rid of that one too. River is, yes, it has a high bond allocation. It's kind of a portfolio when it can, but we're invested into those things as it is. So I can't really justify adding it. HGLB, I'm not sold on long term. I would love to get more info from the company. Overall, yes, it's the sister fund of this one, of HFRO. I dislike how they've gone portfolio when it can. I you know, the portfolio when it can end result really is how Morningstar or anybody else labels the fund. Um, but I would love the source material from the company to see if it's really portfolio when it can, or if that's how it's getting labeled. But on how it's being presented, I will pass. These two, PDO is one of the exceptions to the rule on discount. So when it hovers around, right? So when it's at or below the 52-week average, it's a great deal. And currently it is, but outside of branding, I mean, PIMCO is a easily recognizable brand, and they specialize in bonds, which just inherently, it's like, yes, it's an automatic good pickup, but at the same time, we're also well, I don't want to say well spread out, but we're well invested with other bond funds that simply picking up another bond fund, regardless of how well it's known, doesn't really seem like a great idea to me. And then this one is it's the same thing. Like it's actually in discount compared to the other one, which is a discount based on its own data. This one's at a discount, but it's the same idea. Like PIMCO runs great funds. They do amazingly well, but simply adding another bond fund simply to add another bond fund is over diversification, and I don't like that. I don't like that strategy. So that leaves me with this, which yeah, 8 funds. Um, and we're not investing this week. But if you really held my feet to the fire, like if you really forced me to go, I don't know if I could pick a top five because I mean you and I've covered these so much, I don't want to restate info, but you get a well diversified, internally diversified, primarily bond company who also invest in closed-end funds and crypto and minerals and metals. Like that's great. We talked about this today. HFRO is real estate, but it's not that it's real estate and it's diversified through real estate. It's that it is all real estate. It's just not all online. Like they were developing a hospital building in Dallas. They're onboarding more single family homes. Uh, they're invested into a company that it, they're leasing homes. It's like a rental. It's a home-based rental program. So instead of stacking apartments sky high, they spread them out into a housing community and they're renting out the homes like you would rent out an apartment complex. That's interesting. NBXG is all stock. And then we have municipal bonds. So if you don't have any municipal bonds, buying these at this price may not make sense for you. So that makes it an easy top five. That being said, I still think the herd's going to get pushed into municipal bonds because at some point the Fed, either Powell or somebody else, is going to cut rates. And if money market accounts do what most people think they're going to do and mirror the slashing of rates from that short-term rate, so whatever the current short-term rate is, like the current mortgage rate, 6.8 nationally, I want to say. So if the Fed cuts rates, mortgage rates will drop. And if money market account interest rates follow suit, and that's kind of your safe haven, then you're going to look for a better deal for your savings account. And the best place overall is municipal bonds because it is a boring system that doesn't fluctuate much. It fluctuates. It doesn't fluctuate much. It pays a fairly consistent yield and it's a tax equivalent yield. Um, so it I was not berating myself for doing this before the video, but I don't know if I can thin it out on my end of things smaller than a top eight because these are great dollar cost average buys for us. Um, on our end of things, we bought earlier in the week. That was 460. That was maybe 523. We didn't buy it this week. FCO was a little cheaper. BRW was like a penny cheaper. OXLC was about the same price. Like it's all about the same price right now as it was on Monday when we bought. Excuse me. And I would buy this, even though it's slightly higher than where we currently are, but knowing what they have in their portfolio, and I get that's below 9%, but I see their dividend increasing. HFRO, the more they get, the more square footage they get online, the better. And if they can limp their way through higher interest rates with an overall low square footage online, then I see that coming back up too. I still see hope for that company, even though they're battling this just almost insurmountable discount. So I don't know if I can cull it or shorten it from this top eight. It really kind of depends on your strategy and where you see the market going. The Whatever money you have, the more funds you add of possibility, the less you're able to invest per fund. So if you think bonds are still the way to go, you can list that with bonds. That eliminates those two. If you see bonds and bonds proxies, that eliminates that one. If you want just tech, it's still just that one. It really comes down, like I've said all along, I don't want to invest your money for you. I want to share what we're doing, share share how the market's going, and then give you a better way to invest or present you a better way to invest. So instead of picking up every single fund that this fund owns as single stocks, just invest into one closed-end fund and get a fantastic dividend. I mean, it's an 8% dividend. It's below our average. It's below our threshold of 9%, but at the same time, I'm willing to invest it at 8. It's kind of that, like, knowing that rates at some point will drop. My hope is that the dividend increases. They're they're invested in tech companies, which will go up in value. Short-term interest rates coming down will help everybody accelerate profits more. Their dividends should increase. Um, I mean, it really just depends on you. You've got bond related, bond related, bond related, bond proxy, tech, just solely tech, and municipal funds. If you want to see what we bought last week, which I am still in the process of putting into our spreadsheet, this is what we bought, which is pretty much a mirror image of that other spreadsheet. The one addition is ADX, which I'll do a separate video on why we bought these funds. Um, but we bought 100 set of ADX for, and I'll stick it on the other video. But basically, I ran every argument against buying this fund, even my individual argument of it being beyond my comfort level on threshold and paying a quarterly, that's an estimated dividend based on its prior dividends for the year. And outside of NBXG, I can't think of a counter argument that would prevent me from buying this fund. Like if I want tech, and I want to invest in tech. So if I want to invest in tech and I want a great reward for it and I want growth out of the fund, these two are the funds. Eaton Vance is invested into a lot more funds. It's diversified, but it's almost over diversified. They also sell covered calls, which is a great idea. It helps support your dividend. This fund, we're already invested into this fund. Adding another covered call fund in the midst of a surging economy doesn't sound like a great idea. Like the covered calls are great for that wishy-washy, neutral, grayish. I think the economy is going to do better kind of stock market environment. Not so much we're in extreme greed and everybody's piling in. It should still do well. Every company right now should profit. Every company should go up in value. Every share cost should increase. But we're not just thinking about now. It's the bigger picture. It's what's sustainable, what's going to really grow. And from my standpoint, these two give us the best opportunity to see growth and dividends for the long run. Yeah, but I'll do a separate video on this. But this is where we bought on Monday. So, and I haven't finished updating our spreadsheet with that, which is pretty much the same thing. The only difference is HFRO. But if we're looking to optimize our investments in the midst of extreme greed, if you're looking to optimize your investments, 8 investments or eight buys is a lot. I mean, maybe it's not a lot if you have more money. And that's not saying that snidely, condescendingly. That's not my point at all. To spread 10 grand over 8 funds is challenging. To spread less money over 8 funds is challenging. So your money and your strategy and what you pick can't always pick everything. So if you're going to hyper focus on the current market and where you think things are going to go, all of them are great options. You have to look and see what's best for you, what's best for your portfolio. And if you think the herd will push into municipal bonds, if you think we're on the forefront of technology, if you think commercial and single family real estate are just primed to take off if we see a short term interest rate cut, with same idea between bonds, but then also a business development component with manufacturing and onboarding of um, economical product into the United States, if you think that's going to go well. And then collateralized loan obligation, it really is its own thing. And of everything I've read, a a lagging workforce for whatever reason drags on OXLC. That's the presumption of what's in the market, but that's not what we're seeing. So I don't know why OXLC is actually in discount. But so long as it's in discount, it's a great consideration. So that's all I have. It's a top eight. Um, and it really depends on how that fits into your strategy of how you use the funds to invest. So I will call it there. If you like my content, consider subscribing to my channel. Help me hack YouTube really and get the message out and help more people. So comment, share, and then hit that like button. And then if you want to find me day to day, best way to find me day to day is just to comment on a video. Uh, you can, I mean, helpful, the helpful criticism, but if you want to find me day to day, comment on a video about strategy or where you're investing, or if you like the videos, or if you think they're utter crap. And if you think they're utter crap, you can say they're utter crap, but at the same time, tell me how to make them better. So whatever you have for the week, I hope it goes well. For me, I've got to get back into the swing of things. Last week was just an overall lull. I didn't work out like I should. I didn't get stuff done at the house like I should. I don't know if that's just a midsummer blah point, but at the same time, I got to get back into the swing of things. I've got a spreadsheet to update. I've got a video to do on the market buys we just made. I still have to work on my argument for closed-end funds, and I've still got a book to finish. So I've got a lot to do, and I've got to get motivated to get it out. I've also got to work out. I've got to work out. So working out really does help me de-stress. So not that I'm overtly stressed, but I can feel, I don't feel sluggish and blah after a week of not doing anything, but it's that same internal drive that's like, hey man, you got to work out. You've got some goals you want to meet. Those aren't going to happen if you don't do anything. So I've got a very important week ahead of me with stuff that I've got to get done. Whatever you're facing this week, I hope that goes well for you. And one more thing before I go. I live in Texas. Today was a statewide uh, prayer vigil, almost, or a statewide day of prayer for the flooding in Central Texas. So the, I forget the stats. I want to say on the Llano River, which is or Llano River, however you want to say it, in Central Texas, like the water rose 25 feet in less than an hour, which is, I mean, almost taller than a two-story house. So that's a wall of water. And there are people facing a lot of different things. And I'm not saying Texas is the only state going through stuff. Uh, People don't know what they don't know. Like if you're in If you're in any other state besides Texas, I don't know what news you get. So maybe you don't know what's happening outside of your state, and that's fine. But think of how I want to say this. Whether you know people or not, you can always pray for them. And whether you know people or not, if you feel like you should, help somebody out. And whether that's the homeless guy at the intersection on your way to work or somebody who lives across the country and is now outside of their house, where those moments where you feel like you should step in and do something, like paying for some random guy's meal at Cracker Barrel. Like when those feelings happen, respond to them and not respond to them with, hey, I'll do it the next time, but respond to them with, yeah, I should probably do that. And then do it right then. Like, don't give yourself the opportunity to forget whatever you're feeling like hey, I should do this for somebody. Just do it. And you don't have to draw attention to yourself. You don't have to post it on Facebook and be like, look what I did. You don't have to. And I'm not saying that you should. That's not my point at all. But when those moments happen, respond to them and then help somebody out, whether anybody else ever hears about it or not. Right? Because at the end of the day, all politics and all finance and everything aside, we all just want to help people. So if you can put yourself in their place, if you can empathize a little bit, if you can pray for somebody or help somebody out, do what you can, regardless of whether it goes noticed or not. So whatever you have for the week, I hope it goes well. Whatever endeavor you're working on, whatever project you have, I hope you make progress. And on my end of things, I have a lot to work on this week. So have a great week, everybody. There we go. Have a great week, everybody. I will see y'all on another video. So have a great week. Bye bye.